Hey, it's Kirk here again at Option Alpha. So today's the day that I'm actually going to be taking my pure EV portfolio live. I've been talking about this and documenting this journey for quite some time now. So today's the day that I'm actually going to take it live. I've been waiting till after the FOMC meeting, just to also have some time to get out some videos on analysis for the old Hexabot positions and things like that. But I'm super excited to share some of this today because I wanted to show you guys what I'm doing and some of the changes that I've made personally to the way that I'm trading and how I'm using more data and math and probabilities, even more so than I did before, just based on a lot of the new research. So I'm going to go through that here just to kind of show you the framework and the thought process behind what I'm trying to accomplish with these bots and how I'm setting them up, because I think that's really important. And of course, as always, if you have questions or ideas or you have different versions, please let me know. Of course, please post in the community, share, let's help each other out. Let's try to figure out how we optimize this moving forward. So that's the first thing. This is just what I'm doing here. So this is not a recommendation to do any of these strategies. Of course, you do you figure out what works for you and your portfolio. I'm not saying that this is the best. This is what's working for me. That's what I'm doing personally. Doesn't mean you have to do it. At the same time, it's also something that I'm going to be adjusting and modifying as we move forward. So as new things come out or new data or new research comes out from our team, then I might make adjustments and tweaks to this. This is by no means something that is completely 100% set in stone, although it does have a lot of research already behind it, which is good. Helps give me a lot of confidence moving forward. But I reserve the right to, of course, make adjustments to this moving forward. If I do, I'll document that entire journey with you guys as well. Okay, so let's take a look at just really quickly where our EV portfolio is. It's always good, I think, to get just another baseline look at how much or what this EV portfolio is doing. So inside of my account, again, I have this completely separate portfolio, this paper trading portfolio that I've run the entire time from the beginning of documenting this journey with you guys. And currently the EV portfolio is still up some money. If I go over to the positions tab and then I go over to analyze, you can see that as far as closed positions go, the EV portfolio has about $10,000 of closed positions. Some of the open positions that are still there have a negative P&L. That doesn't mean it's going to be negative at the end of the day. It just means that right now that those positions are underwater. So some might end underwater, some might turn around, etc. So if you look at just like the closed P&L on positions, knowing that there's some fluctuations, it's still pretty good. If you look at the position number and count, we've gotten this thing up to over 1,000 positions, which originally the whole idea around entering these EV portfolio trades was to try to, forward test and live test, if you will, this concept of pure implied expected value and try to figure out how we can kind of capture it. And so it's done pretty well. It's targeted right above our win rate, which is what we've been targeting, around 70%, which is open to modifieds and adjustments, as we'll see here in a little bit. And our profit factor has been pretty good. Average days in trade, we've been entering trades about 6 days out. It's been holding trades about 5.5 days. This is pretty interesting because we've been doing this, again, deliberately during this portion of the experiment to try to get a lot of trade occurrences, try to kind of prove out some of this. So we might push this out just a little bit on timeline and where that goes. As far as strategies go, iron condors have been, truly crushing it. Call spreads have been pretty good. Short put spreads have been losers. I think at one point the short put spreads were winners, but haven't been doing so well. Symbols wise, a lot of fluctuation has been happening in symbols. QQQ seems to be the winner here, but some of the ones that have kind of matured into their losing positions would be stuff like Roku, which just never has seemed to turn around. Some of the other ones like Tesla used to be a big loser, or Netflix used to be a big loser, turned into a big winner. Tesla used to be pretty extreme in both cases. Now it's kind of midway here. So it's pretty interesting to see where things kind of shake out here as we get more data. All right, so moving forward, there's a couple things I wanted to go through. And I thought this was important because seeing some of this data to me is really helpful, and I think it might be helpful for you. All of this is already published. If it's not already published, I think maybe one piece of this is coming out very soon from our team, but the rest of it's published. We publish it for free. We give it away for free. You just have to consume it and take the time to understand it, and we hope we do a good job showing you this. The first one here is this chart. Now, I think this research article is coming out very soon, so it's in the back, like the draft and finalization stage, but here's the research we did here, and this is why it's so important. We basically took a look at the different ways that predicted probability versus win rates, basically like what those actually end up being over time. So if you get into a trade and it's a 70% chance of success, does it actually end up being a 70% chance of success, or does it end up being a 75 or an 80 or whatever? And again, this trade's taken all the way to expiration. So like, do the probabilities effectively play out? And we've done this a number of times over the years. This is not the only time we've done it. We have lots of backtesting data, lots of research on this. And generally, you can see that, yes, the probabilities play out. And you can see this because if you have a 70% chance of success trade, or a 70, or like these ones here, 70% chance of success trade at trade entry, did the probability actually play out when it actually got to that data point? And you can see that it's probably in the same trajectory. There's some fluctuations here and a little bit of volatility in kind of the curves of these probabilities. That they're not all perfect, like 70%, but you can see they're in the general range. We don't see any ones that are, where you are targeting a trade that's 70% and that trade ends up winning most of the time 50%. Like, it's pretty rare that you get such an extreme example. Actually, it doesn't even happen. So that doesn't happen. What you do see here, though, is you see that different ranges of probabilities definitely have some different volatility of the actual ultimate probabilities playing out. And so, for example, this like 50 to 60 range, so if you're targeting a probability of, in this case, max profit 50 to 60%, then what you see like a fairly tight range here where the probabilities actually play out around 55%, which is about the average between 50 and 60. So when you go to this one here, which is the 60 to 70% range, you can see that you get a little bit more variation, but still very tight around these ranges. That's what you would expect to see. It's actually when you get out to the 70 to 80% range, so you're really selling premium very far out, you're trying to capture a lot of premium here, or a lot of like really high probability trades, you start to see more fluctuation in this. Now, it doesn't lead us to say like, oh, it doesn't work or we can't do it. It's just that you get a lot more fluctuation in there, specifically around the shorter durations. So if we actually just, again, I'm just trying to visually chop a lot of this up so you guys can look at it a little bit different. But if you visually chop up even these two ranges here, so let's go chop up these two ranges and say 15 days to expiration to out to 30 days. And then inside here, let's look at the, let's see, these ones are 0 days to expiration to 10 to 15. You can see that the difference between these two column like general duration ranges is pretty significant. Inside 15, 10 days specifically, you can see a lot of volatility and under assumption of actual final probabilities around 10 days. You get a lot less security, if you will, in those probabilities. And you can see that visually here by the graph kind of dipping below these theoretical perfect lines here, these dotted average lines, for most of the days to expiration around 10 days. So it's like 7 days seems to be pretty good here in this range. 10 days seems to be potentially something maybe you avoid. And then you get out here to like the 20 plus day range. It seems to like really level out and consolidate around what it should be on average. So you get maybe more predictive power out here. Maybe it's 7 days or so, you get a little bit better, but inside say 0, 5 days or 10 days, it's not as great. So that maybe is something that you consider moving forward. For me personally, what I'm going to start doing here with some of these EV bots is start moving the average days that I get into trades out into this block. So I'm literally using the data here to adjust what I'm doing and basically move some of these out into this more predictive basket of duration and days to expiration. And that's just going to be a setting that I do inside of this EV bot. Now, it is interesting to note that a lot of the ones that I was targeting was around this like 5 to 7 day time period here, which ended up being okay. It wasn't perfectly perfect. In some cases, didn't have a lot of data around 6 days or so, but a lot of these ended up being okay around 7 days for average time that we saw in the EV portfolio. Had I moved that out to around 10 days, maybe the results would have been a little bit different. But again, this is using all data of live trades that we have access to. So millions and millions and millions of potential data points that we can look at here. Okay, so that's the first thing. So we want to know, or I want to know, like, do the probabilities actually play out versus their win rates? In this case, they do, and they're good enough, they're solid enough that we can use them moving forward. Next thing is EV. We've talked about this all the time. We did this in the first videos in this series where I just kind of went through like why do we need expected value, how we calculate it a little bit differently, and why you should be using a tool like Option Alpha to help you figure out those trades that have positive expected value. And the key here is that when you have positive expected value, this is the average P&L for trade ideas that found positive or negative expected value, because we can track those too. You can see that the end result is that if you had an expected value of, say, $20 or $30, how often were you going to get that expected value? Or did you get a little bit more premium, or did you get a little bit less premium net? And you can see that generally it tracks that perfect theoretical EV line, which is great, which means that we can use reliably expected value, positive expected value trades to help inform the decisions that we make about which trades we want to take. Of course, we want to take trades that have a positive expected value. Now, previously, ultimately a lot of traders, what we did is we did classical trading, which was that we guessed that maybe some of these trades worked out. Maybe you did a little bit of math getting into positions. Maybe you didn't do math getting into positions. But now that we have a tool like this that can show EV and can calculate and rank EV, we can use this moving forward for our trades, and we know that there's some predictive reliability around EV. Okay, so that's the next thing. It's like probabilities we can use, EVs we can use, maybe some different ranges we can use. In my case for EVs, I'm going to be avoiding some of these really, really low EVs. For the EV portfolio, we did only positive EV, so we're going to adjust that up just a little bit so that we're not trying to capture just those theoretical, like small little edges. We want the portfolio to take potentially better trades. So maybe we'll call it, say, EV has to be above 10 or some metric, something like that, like something where we're trying to capture more than just $1 of positive expected value. Now, again, the previous tests in EV portfolio that we've done from this point was just above $1, I think maybe above zero, maybe it was above zero of expected value. So we don't want to use just zero now because we don't want to just churn everything out. It worked out in our case, but we definitely want to start moving that EV a little bit higher. We don't need to go for some crazy, crazy metrics like 90 or 100 or something like that, because I just don't think that's realistic. A lot of the data out there is just not reliable enough yet, because we just don't have enough trade count out there yet to say, yes, 100%, but theoretically it should continue to move towards this as we move forward. So we're going to go in that like 10-ish range or so as just like a floor or minimum for expected value. Okay, the next thing that we looked at, and again, we did a lot of research on this, published a lot of research on this, did videos on this, is the average rate of return for alpha. And this is really, really important because not only are we looking at just EV, but we can't look at EV in a vacuum. So if I have two trades and I say like one trade has an expected value of $100 and the other trade has an expected value of $50, you can't just say that the trade with $100 of expected value is better, because it doesn't include the risk component. So there's got to be a way for us to neutralize and standardize the amount of risk that we're taking to capture that potential return. So this is where alpha comes into play. It just takes the EV of the contract and divides it by the max loss, which is the risk on the position that you're getting into, to try to normalize and neutralize that for the amount of risk that you're taking. So if you have a trade that has $100 of EV and another trade that has $50 of EV, but then once you look at how much risk those trades are taking, maybe the $50 EV trade is a better risk on, like, return on risk, because it isn't as wide of strikes or doesn't have wide wings or something like that. So the risk that you're taking to capture that potential $50 EV is a lot less. So this is where alpha comes into play. Alpha, the higher the alpha is, the better the risk, the return on risk for that position for capturing that EV is. And in this research that we published here, you can see that the same thing ended up holding true for alpha as for EV, which is that, okay, is alpha an accurate predictor of where the rate of return is for trades? So if alpha was suggesting that we were in the 20% bucket, did we actually end up in the 20% bucket once we actually saw the trade play out? And the answer to that question was yes, it did. So for all of these alpha metrics here with lots and lots of data points, we're pretty confident that we can say that alpha is a pretty good, reliable indicator for measuring that return on risk, which means that we want to avoid negative alpha trades. Of course, we don't want to be trading anything with no or negative EV, no or negative alpha. We want to avoid all of those. And we definitely want to be, again, maybe in this, sweeter spot, I guess you could say. I'll call this sweeter spot, which is like the 10 to 15 alpha. Doesn't mean you can't go higher. You can obviously go higher in alpha if you want to, but those trades might not be as frequent. So you might have to hold for those positions a little bit longer. You may not get into a lot of positions. So for you personally, it may space out trades a little bit more. I'm more comfortable getting into lots and lots of trades, letting these numbers and math play out in my favor. And so I'll be targeting somewhere like alpha, somewhere around 10 to 15, maybe 5 or above as just like the general guidepost for moving forward. Okay, some more stuff here, some more research and data. And I hope what you're seeing in watching this video and doing this and just me sharing what I'm doing with mine is I'm truly using data and research to inform my decisions about what I do. I'm not trying to be emotionally subjective. We don't have any technical indicators in this. In the future, we might do some trend or some overbought, oversold stuff where we tilt and use and incorporate some of the Hexabot stuff that we learned from the last couple of videos with the tags and the analysis. But right now, the core of what I'm trying to get accomplished for me personally is, can I use data and research to inform these decisions versus my subjective bias and opinions on what may or may not work. So I'm just using the data, build a bot around the data, and then move forward with that and start to make adjustments. The other thing is our team and Jack just published a great video the other day on which profit-taking exit works best. This is on all live positions, all trades, all DTs. Just looking at, okay, if you had profit-taking on your exit options, what profit-taking metric would work best? And this was really, really fascinating. For two reasons, I thought this was personally fascinating. Personally, I thought that the none profit-taking level was extremely fascinating. This is just letting trades go to expiration, which kind of proves the point that implied volatility is overstated compared to historical volatility, which is ideally what Trade Ideas is trying to figure out and capture those best trades that have the most discrepancy between implied and historical. And here you can see that just letting trades go, again, as we've said for years, like just not touching trades at its worst case like scenario, actually ended up doing pretty well. What was interesting here, I thought, was actually 50%, which I've personally used for a lot of trades that we do. Although some of the Hexabots had used earlier profit taking like 25 and 30%. I think our 3K portfolio uses about 35%, which has been actually very interesting to see that one up here. But most of the historical stuff that I used to do was about 50%. 50% was about marginal at best. In some cases, maybe you were waiting a little bit too long to capture your premium and you had an opportunity to slip by and then it turned back around. So that was actually very interesting that has started to kind of shift potentially out of favor maybe, and we avoid that. What's interesting about this one here for me is that the top two with a lot of trade count and size were 40 and 35%. So for me, this is really interesting. The numbers here and even the differential in the average rate of return on a trade or the return on risk for these trades is pretty significant. And that just goes to show that if we went towards these, kind of low but not mid profit-taking tiers, we're not doing 5, look at 5. 5 was one of the worst performers for profit taking. 10, again, one of the worst performers. Holding all the way to expiration or very close to expiration, not so good either. You really had to take profits early, but not too early and not too late. So it's kind of like that sweet spot, that Goldilocks type of profit taking. And in this case, it was very interesting to see that these were the ones. So 35 and 40% were pretty favorable for profit taking. So for me, I'll be using 40% moving forward for these EV portfolios. If we get more data, more research that shows something different, we can adjust it from there. But that's pretty good for me. That allows me to capture enough of the premium in that trade, but I also have the backstop knowing that if I even let the trade go to expiration, that I still should make some money on these trades. And even more so than that, if I let the trades go to expiration, as this EV research that we published here shows, I still should capture that expected value that I'm after. So the goal here for profit taking is to remove the risk, capture that premium that we were trying to capture early. But again, we have the backstop of letting the trades go to expiration if needed. Now, the second question that people are going to be asking besides this is, well, what about a stop loss? If I let the trade go all the way to expiration, should I use a stop loss? Does that help out? Once again, and we've showed this for years and years and years and years, and we've said this so many times, but the absolute best stop loss was no stop loss. I've literally, if you followed me for years, you see like every time we do this research, it like just proves the point over and over and over again, which is that you can't use stop losses for your trades because ultimately position sizing, that is one of your most critical risk management techniques. You position size accordingly, you get into diversified tickers, try not to have all of your positions on one side, space out your durations and ladder into your positions, meaning don't throw up this big position one time on one symbol in one environment and hope it works out. That doesn't work. So this is the key right here, is like use risk management techniques like position sizing, spreading out uncorrelated assets, etc. And ultimately, you gotta trust the math and the probabilities of whatever you're trading. And I've shown you all the research on this. So for me, I'm trusting it. I'm not using a stop loss. As always, I don't use stop losses on my trades. You can see that none was actually the most profitable as far as the average return on risk. If you did start to deploy stop losses, it really actually got significantly worse for you all the way across the board, and was very, very interesting. I think what's particularly interesting is some of these early ones that people like to do. Some people like to do these where they do 5%, 15%, 10%. Like, hey, if it doesn't work, and this I hear all the time, if the trade doesn't work out early, it's not a good trade. Well, it just really doesn't seem like that's the case. And, a lot of people are like, oh, cut your losers and get out of the trades and, reverse the, if it's not working, get out of it right away, tight stops, all that stuff. I just don't think it works in the way that most people want to trade options, which is to sell premium and take advantage of this mispricing and implied volatility versus historical. And so you can see that some of these like 5 and 15 and 10 was actually really, really bad. The average return on risk was negative for those, so you really didn't do yourself any favors at all. In fact, you just literally cut your legs out from underneath of you and didn't help yourself out. Okay, so all of this research, again, it's published. If you need or have questions on it, please let us know. We'll continue to publish and give this stuff to you guys for free. It is basically doing what I've been wanting to do, which is to use this research to continue to inform what I'm doing on these bots. Okay. So here's what I'm going to do in this video, and I'll go through it in some other videos too as we continue this journey. This is not the end of the journey here for the Pure EV portfolio, but what I want to do is I want to just build out this first one here, show you what I'm doing. In other videos next week, we'll show you how I'm scaling out these bots to other ticker symbols, doing some research on some uncorrelated ticker symbol assets that we want to use. So we're going to do a mix of ETFs, mix of stocks, because both actually did perform decently well, and both actually are needed to make sure that we create some stability in uncorrelated assets in the portfolio. And we can trade these now, not worrying about earnings or ex-dividend dates, things like that. So what I'm going to do is I'm going to build out the first bot here for you in this video, and then in subsequent videos, we'll expand this out to other ticker symbols and other bots. Now, the first one I'm going to start with is just simply QQQ, is the best performing one. So I'm going to take this one and I'm going to make some changes to it and convert it over. So the first thing I'm going to do here is I'm just going to clone my paper trading bot. This is how you take a bot live, if you will. So a lot of people ask the question, how do you convert a bot and take it live? Well, you can't convert a paper bot to a live bot. You just clone the bot and basically move it to a live portfolio. So in this case, I'm going to do QQQ. I'm going to move this over to my main Tradier account. I'm going to give it a capital allocation. We'll just give this one $1,000 for now to start. Should do small positions. Actually, we'll bump it up to like $3,000. And the ticker input for this one is QQQ. Okay, so I'm going to go over to the bot settings now. Now in the bot settings, you can see I have my safeguards, 1 daily position at a time, 10 positions at one time. I'm totally good with all of those. And my only input right now is the bot ticker, which is the same Pure EV experiment that we've been running before. So what I want to do here is I want to create a new automation, and I want to base it off of this one. And the reason I want to create new automation is because I want to add all of this new stuff that we've been talking about here inside of this video to that new automation, basically make adjustments to this existing one that we're running right now. Now remember, this existing one that we're running was checking trades around 7 to 14 days, had profits targets at 80%, which was probably too high, obviously, at this point, and probably didn't help us in any degree. And then we had really, really low EV per contract of just 0. We were targeting probabilities of profit of 70%. So again, maybe a little bit high. So we want to make adjustments, but I don't want to stop and completely abandon this particular automation because we might go back to it. I want to let some of these EV portfolios still run and testing wise. So what I can do here is I can add an automation here, and then in the drop down, I'm going to go to my Pure EV scanner and I'm going to create a copy. And so copy is just a brand new version based on the existing version here, which allows me to create a new version that I can use for my live bots. So I'm going to call it my Pure EV scanner, and we'll just say that this is for live positions, okay? So here I'm going to make adjustments first to the trade ideas. I'll come back to this first decision here because a number of people pointed out I made a mistake here and an error in this that didn't account for new positions and new bots. So I'm going to correct that here in this video. Okay, so first I'm going to go down to my Find Trade Ideas action. The ticker symbol is linked to the ticker symbol that I want. Again, the strategy, I'm going to leave it open-ended. If it finds that iron condors are great, great. If it finds that short call spreads are great, great. Put spreads, great. Whatever it wants to do. As far as expiration goes, remember, I'm going to move this out to a little bit further duration. So we're going to call it, say, like 15 days to 30 days, because that's where bulk of the research is, and a lot more stability around some of these are in that time period. So I'm going to move this out from 15 days. I'm going to go out to about 30 days, maybe about 30 days or so for entry. So it can find a position that's at 15 days. It can find a position that's at 30 days. Ultimately, I don't care which one it does, as long as it's in that time period. It's not going to find a position that's 1 day or 2 days or 5 days or 0 days, because I'm deliberately telling it not to do that. Position sizing, I'm going to say one contract, of course. Make sure that we keep our position sizes small, because I'm going to allow for laddered entries, which means that rather than doing 10 contracts now, I would do one today, wait a couple days, do one, wait a couple days, do one, et cetera, et cetera. Mid-price or pricing for those entries. So in this case, what I'm going to do is I'm actually going to use fast, smart pricing and reduce the number of attempts that I'm going to do, because I just want to get to that actual price that I'm allowing to. And remember, in the original video, I talked about how we were going to do slippage a lot wider for paper trade. Now look, this is one of those things where I do think that the difference between paper trading and live is going to be pretty substantial. So I'm not naive enough to think that paper is going to be exactly the same as live. There's no way we can perfectly replicate a live environment with a paper trading environment. There's no way we could do it. So I allowed more slippage inside of the bots for the paper trading environment. Now I'm going to reduce that slippage down for the live environment. That means that I might not get into the exact same trades. Obviously I won't, but I'm going to be more strict with my rules for trades that I get into and not allow as much slippage. So I'm going to move this down to about maybe 4 cents of slippage from the mid price. I really don't want to go too far from mid price. I want to reduce that down pretty significantly and go from there. Okay, so we'll move it down to 4 cents. Exit options, these ones are going to be different now. Remember, we did some research on exit options. 80% ended up working out pretty good. It wasn't the perfect one by any stretch. So in this case, using 80% was okay, but we found out that about 40% works out a little bit better. And in this case, I'm not going to use normal pricing. I might make too many attempts. Again, I'm just going to use fast, smart pricing. Actually, in this one, I'm just going to use limit pricing, which should get us right to that exact 40% or better threshold for that, and get the position off. Now, no trailing stop, of course, no stop loss on these. And then as far as expiration goes, I'm going to go ahead and leave this as 15 minutes before expiration with 100% of the bid-ask spread. This one is really interesting to me, because what I want to do here is I want to leave this as a backstop. Now, if any trades get to this point where it's 15 minutes before expiration, I definitely want something that will allow it to go 100% through the bid-ask spread, get the position off to reduce the assignment risk. Now, with the original pure EV portfolio, which was paper trading, there's no assignment risk in paper trading. This is a real risk that we have to consider as we start transitioning over to live trading. So this is going to be my backstop. This is not going to be the only thing that I do. In other videos, I'm going to show you guys, I'm going to be building out maybe a monitor automation or so that would start the process of monitoring these positions maybe a couple days before expiration. Remember, we're getting into positions 14 to 30 days out. So we have some time that we can get into positions, let them mature, but if they start to get to the point where their assignment risk starts to go up, extrinsic value starts to go down on some of the short legs, you might want to exit some of these positions early, remove the risk, and recycle the capital. So this to me is 100% our kind of backstop setting. This is our like our final Alamo setting is to remove these positions 15 minutes before expiration. You could even move this down to like 30 minutes before, which I might do, and just keep recycling it to make sure that these positions get off. Okay, if you want to avoid pattern day trading, which I do for some of these accounts, then what you want to do is just check that box here to avoid pattern day trading. Again, this would be totally subjective to you and how you want to do it. For me, I don't necessarily need this in my TradeAir account, so I'm going to go ahead and remove that. Now in this case, disabling exit options if the bid-ask spread exceeds a certain width, I'm not going to worry about that here because I'm already filtering for high liquidity tickers as they come in, and I'm also using mid pricing on the way in for it. So even if the spreads go wide, I'm just going to go a couple pennies from mid pricing. And as far as the profit taking goes, it's always going to ensure that I capture my profits. So also if the bid-ask spread goes really wide, it's not going to go with it and capture something that's not a profit. So I don't have to worry about that necessarily. So I'm going to go ahead and save those new settings here for these and continue on moving forward. As far as entry criteria goes, here's what we had before. The bot has enough capital available. That's an easy one. Like before I get into a position, make sure that the bot has enough capital available. Bot opened less than one position today, so that's of course good. I don't want to get into multiple positions, one position per day. I can use this one to do that here as well. I don't really care about multiple positions for the actual symbol itself. If you only wanted to open one position per symbol, you could easily check this box. I actually want to open multiple positions in that ticker symbol because each bot is going to be inside of a ticker symbol. So I don't want to check this box here. I do want to check this box for identical legs if you want to make sure that you're not stomping on the same legs. So there's a little nice article about how this works here. So if you don't want to trade the same legs, then you can check that box for identical legs. I don't care necessarily for a lot of these, so I'm going to leave these unchecked for now. I might come back in here and check it maybe in the future, but I don't really care if the bot kind of has identical legs for a lot of these different positions. It might double up on positions, and that's totally fine, and I'm okay with that. Okay, VIX, I'm going to add a maximum VIX level. So I'm going to say VIX is below 0, and we're going to add a maximum VIX level of 35. Now, the reason I'm doing this here, and you can do this as a decision inside of your automation too, is because I don't want to trade this strategy when volatility is super, super high. When volatility has been generally lower, I'm okay with this. That's where a lot of the research is. There's not a lot of data during time periods where the VIX is super, super high, so we're just going to avoid it. The VIX goes high, we can make adjustments to individual trades inside the platform, but we don't want to continue adding new positions in a super, super high volatility environment. We'll wait until it calms down just a little bit more. And again, 35 is still generally pretty high, but it's not 40, 50, 60. We'll just avoid all of those altogether. Mid pricing is between 12 and 15. Now, the reason that we did this originally, if you remember from some of the previous videos, is because we wanted to avoid time periods where it was getting into trades for $1 or $2. So this means that when we get into a position, we want that mid pricing at least to be $12 or more for some of the tighter spreads that some of these tickers might trade. In all reality, it's probably going to be significantly more than that. But this kind of keeps out low bidders, as my mother-in-law would say, and kind of prevents it from getting into positions that have really, really high alpha, but also have very, very small premiums, maybe $2 or $3 for a 50-cent wide spread. We don't want it to do that. Expires before the next earnings report. We're going to do that. Also expires before the next FOMC meeting. We're going to check that for now. Since we're taking it on live, we don't want to mess with any of this other stuff. Expires before next ex-dividend day. Yes. EV per contract. Okay, so let's go back to this one here, which is EV per contract. We're going to go above $5 here, maybe $10 or so. It's totally up to you. Maybe we'll start at 10 and kind of work our way back if we need to. But again, we don't need to go perfectly above 0. So previously we went above 0, which means that even if it was $1, we would take the trade. We don't want to do that. We want to be a little bit more picky and choosy. So let's start at $10 per contract greater than that, and that would set that boundary. Probability of profit. This one is one that we're actually going to scale back. If you remember from this research here, we're going to scale this back because the 60 to 70% or the 70+% range, which is basically where a lot of these were originally done, works, but it has more volatility in the actual results. So there's a lot more discrepancy in that once you start getting to those further probabilities. So in this case, what we're going to do is we're going to scale this back to a probability of profit greater than 60%. That should keep us into a tighter range of wins. That also is going to bring down our win rate, which is okay, but hopefully we're capturing more premium net on doing that. And then the last thing that we're going to do here is we are going to leave this probability of max loss per contract at 500. This is really good. This ensures that it doesn't take a trade that's a $15 wide spread on Tesla or something. So I want small positions, small position sizes, low risk per entry that I get into, so I can get into enough trades for these numbers to actually play out. And of course, we're going to rank ideas by alpha. And the reason that we're ranking ideas by alpha is because we don't want to rank them by EV. In my case, this is just me. You can do you, of course, but I don't want to rank them by EV because if I rank them by EV, I could take a trade that has a really good expected value, but a huge amount of risk. And so remember, alpha kind of normalizes that and also takes into account the risk that you're taking to capture that EV. So we want the highest alpha ranking trades as the trades that we take for our bot. Okay, so once I save those are good to go. The only thing that I have to do here is I just have to fix this first decision here. And this is kind of my laddering criteria. So I'm going to obviously make adjustments to this. But what I did originally when we made adjustments to this is I saw that the bots were entering, and this was just because we were just building this out as we go, but the bots were entering a new trade basically every single day. And so what I wanted to do was I wanted to spread out those entries so that it didn't get into 10 trades that ended up being 10 of the exact same contracts. So I want the bot to spread out these trades to give time for each of these individual markets to move so that it doesn't get pigeonholed in a series of contracts that ultimately turn around and get whipsawed. So in my case, I'm laddering these positions more than 3 days apart. So that means I might get into a position today and then wait 3 days and get into another position. Or if it doesn't find a position that day, might wait 4 days or might wait 5 days. That's okay. I'm allowing it to space the trades out so that it gives time for these markets to move. And I don't get stuck and pigeonholed into a series of contracts. Now, this decision here, the bot last opened a position more than 3 market days. That's a good decision. But what I didn't account for, and thank you to everybody who pointed this out in the last video on this particular topic, was I didn't account for the fact that the bot didn't have a position already when it starts. So when I start this bot right now, it's not going to have a position. So of course, there's no way to validate this particular one. The last open positions never had a position. This is a brand new bot, turning it on live. So what I need to do is I need to add another decision here to check and see if the bot has 0 positions. So we're going to do 0 positions, has exactly 0 positions of any type. And we're going to do OR, okay? So the reason that we're going to do this is because we want the bot to check. Does the bot have 0 positions, i.e. this is a brand new bot and this is the first trade that it's going with? Or does the bot have positions and make sure that those positions were opened 3 days ago? So this is a existing bot that's now trading. You want to make sure that it's spacing out its trades. Now, of course, you can modify this to make it whatever you want. I'm going to do 3 days from now, 3 market days, not 3 calendar days. I don't want to do a trade on Friday and then on Monday. So I'm going to do 3 market days. That'll give some time for it to space itself out and continue moving. So once I do this, you can see it's updated here. I'm going to go ahead and edit this caption here so I know what this is. This is the laddering criteria for spacing trades. Okay, and that's just edited so I know and keeps it kind of clean and simple. So first thing is when this Pure EV scanner starts running, it's going to just make sure that it's laddering and spacing trades correctly. If it's allowed to open a position, i.e. the answer is yes, then it's going to go ahead and move down to the find trade idea action, which is going to go through all the criteria that we just went through. And again, inside of here, we're already taking care of our exit options attached to each positions. We don't need a monitor automation. We don't need anything else. We need the simplest possible scanner on human on planet Earth here and try to get this thing up and running and moving. Okay, now that I have this new Pure EV scanner, and actually let me just go back in here really quick. I'm going to go ahead and save this to my library. So that's saved in here. I can reuse it across other automations or other bots, which is good. I'm going to go ahead and here and schedule this as a scanner automation. I'm going to confirm that I want to use this on not SPY, which is the default symbol for the scanner, but actually on QQQ. And I'm going to connect this to my bot level ticker input. So it's using that QQQ across the board, and go ahead and save. So I have my Pure EV scanner automation in here. I copied it from the existing one. Now I can just simply go in and delete the Pure EV experiment automation. Now remember, I'm just deleting it from this bot, not deleting it from the whole thing. So I'm going to go ahead and delete this, remove this one, and I should be good to go. So at this point now, after a long video and a lot of discussion and hopefully a lot of help, and I hope this has been helpful, you guys can see how this works. I'm going to go ahead and turn this one on. So all I simply need to do is turn on the automations. That means that the next interval, the scanner automation will start running. Hopefully we'll have our first position today, and we're off and going with this new Pure EV portfolio bot, which is kind of crazy, but the long road to get here. Hopefully it was a good journey for you all to see how I did this. kind of documenting the process of using research and data and then testing and modifying things, using paper trading to our advantage to find things that we didn't want the bot to do or didn't think about or didn't consider, which is always going to happen. And then now using this to move forward in a smart, hopefully intelligent way. So as always, if you guys have any questions, please let me know. I'll be doing, again, follow-up videos on other parts of the process, creating more bots, creating new automations, managing expiration, seeing and showing how the performance of the bot is doing as we go. I hope you guys enjoy these videos. If you do, please let us know. Give us a thumbs up. And until next time, happy trading.